In July this year, videos of tanks rolling into the streets of Henan went viral on Twitter. Apparently, these tanks were deployed to protect the Henan branch of the Bank of China, as thousands of protesters line up after their deposits have been frozen since April. Now, the post turned out to be a hoax, as it's just an annual military exercise in Shandong, 248 miles away from Henan province, and doesn't involve any bank protests whatsoever. But the incident brought the current Chinese banking crisis into the spotlight. This crisis adds another major blow to the Chinese economy, which is still grappling with its property sector meltdown and mortgage boycotts throughout the country. And while only a handful of banks are caught up in the crisis, the situation could worsen if the public start worrying about other banks, especially larger banks. And these smaller banks are actually far riskier than most people might think, with systemic implications. Now, the Henan banking crisis emerged in April, when 4 rural banks freezed $6 billion worth of retail deposits, which includes many people's life savings. This incident sparked bank runs throughout the country, and in July 10th, thousands of furious customers staged a mass protest at the Bank of China branch in Henan, demanding their life savings to be returned. The protesters were later beaten up by a mob of unknown men dressed in white shirts, and multiple bank customers have been harassed, attacked, and interrogated by the police. Henan is a large, agriculturally important, and landlocked province located in central China, and has a population of just under 100 million, around 1/3 of the USA, and a GDP of nearly $1 trillion. The 4 banks that fell focus mainly on the local economy, primarily agriculture, and according to Chinese authorities, they are the riskiest part of China's banking system due to their weak risk management, concentration on the agricultural sector, and vulnerability to the whims and demands of local governments. Now, in recent years, small regional banks in China often find it difficult to attract deposits from local customers, mainly because the population in general are poorer, and the rise of internet infrastructure has made customers shop around the country for higher interest rates on their savings, as opposed to before the internet era when they can only deal with a few local banks around their neighborhood. Over the last few years, these small banks have tried to attract customers with online deposit schemes and through agents who offer benefits for customers to open a savings account. Now, because these schemes are hard to regulate and ripe with fraud, the Chinese government made these practices illegal in early 2021. But apparently, most banks still do it even today. In an example of such schemes, an online platform can sell products of a specific bank with a suspiciously high interest rate of around 4.5%, compared to many large banks that offer around 2.5 to 3.2% interest. Because of the high interest rate, they were able to gain customers not just within the province of Henan, but also in neighboring provinces. So there is a risk that the deposit freeze will result in contagion to other provinces. Now, at first, the banks say that the deposit freeze happened because they were upgrading their online banking system. But as time went on and people were still unable to withdraw cash, then they become increasingly concerned, especially at a time when local banks are plagued with systemic issues caused by the property market meltdown, zero COVID policy, and the growth of China's shadow banking. So on May 21, demonstrators marched toward the CBRRC office in Zhengzhou, the provincial capital of Henan province. This issue became a national embarrassment when depositors in Henan found out that the COVID public health codes on their phones had turned red when they scanned QR codes in trains and bus stations, meaning that they couldn't travel or enter any public spaces, even though virtually all of them tested negative for COVID. And suspiciously, only depositors who had money in one of the 4 banks had this issue. Many people suspect Zhengzhou authorities manipulated the health codes so that people couldn't gather around and protest. And while authorities said it was a computer glitch, few believed them. This incident created outrage throughout China. One depositor who planned to protest said that the health code should have been used to prevent the spread of the pandemic, but now it becomes something like a good citizen certificate. In the end, Beijing had to intervene and 5 government officials were punished. On July 10th, a much larger protest occurred, and the protesters were beaten by unknown men in white shirts, creating unrest throughout the country. Now, the very next day, authorities arrested a criminal gang that they say to have gained control of several village banks illegally, sold financial products through their online platform, and set up shell companies to conceal the data. And on July 12, regulators ordered the depositors to be partially repaid in batches. But this begs the question, who will pay depositors and cover the losses? At first, it seems obvious. China has a deposit insurance system that covers up to 500,000 yuan or $72,000 per person should a bank cannot pay its obligations. Of course, some people deposited far more than $72,000 and many of them might not get their money back. This is a bigger problem than many people think, as wealthy investors invest in risky projects with the assumption that banks, the government, or some type of entity will bear the risk and bail them out. A serious moral hazard. If wealthy lenders withdrew their financing on risky banks and loans, that might cause a downward spiral in the bank's attempt to restructure. But it turns out that the deposits weren't actually bank deposits. Apparently, the money being raised from those online platforms was poured into other assets, meaning that people were scammed. And several bank officials have been arrested for this mislabeling. And that explains why these so-called deposits have much higher interest rates. If they are not bank deposits, then the deposit insurance management company, Henan authorities, or even China's central bank actually don't need to pay off depositors. But not paying bears the risk of stoking fear and uncertainty among depositors throughout the country, as this issue is already quite viral. And it can even trigger a contagious bank run that leads to a systemic banking crisis, especially as trust in authorities is already pretty low because of this issue. So, not repaying depositors is not an option. It will appear that local governments have been tasked with repaying depositors, but this raises another issue. Virtually all Chinese local governments, not just Henan, have seen their revenue source drained and their costs increase. Land sales, which are their biggest revenue, are pretty much gone because property developers have mostly gone bankrupt or in severe financial distress. The zero-COVID policy has slowed down economic activity, pandemic-related costs are also rising, and not to mention, they have to deliver high GDP growth targets from the central government. Now, they have to pay back depositors who got scammed and recapitalize the banks. It's a bit much. And we've already seen the side effects. Local governments which are in desperate need of funding turn to putting taxes and fines on small businesses to make up for their declining revenue, to the frustration of many business owners. And we can expect this practice to put pressure on households. To me, it seems like no one wants to pay and try to pass on the cost to someone else. But ultimately, somebody will have to bear the costs, and the one who has the least political power will be the most vulnerable. The problems in Henan province do seem to spread to other provinces. The province of Anhui and Liaoning are seeing similar problems right now. And of course, this is to be expected due to pressure from the property meltdown, as banks have been engaged in risky lending with the expectations that real estate prices always go up. And like I said before, the runs of these small village banks do have systemic implications. This World Bank research, for example, finds that systemic risk in the Chinese banking sector has been rising rapidly since the 2008 global financial crisis, due to increasing housing prices, policy uncertainty, and shadow banking. And smaller banks appear to be more interconnected than their large counterparts and have greater influence than many people think. This graph measures the systemic risk of China's banking system, and as you can see, they've been steadily increasing for the last 15 years. Before 2008, the Chinese banking system was resilient to the global financial crisis, mainly because it was focused on a strongly growing domestic market and had little exposure to overseas markets. The large increase in systemic risk during 2012 coincided with the end of the 2008 economic stimulus package, which led to a surge in credit volume and asset prices, including housing prices. We can see another increase in 2015 and 2016, when the Chinese stock market crashed. The research stated that smaller banks have not only become more important individually, but also can exert significant sectoral influence. Although we do not disregard the capacity for intervention of Chinese regulators, our result points toward an increasing vulnerability of China's banking system due to contagion effects. And by the way, this research was published in February 2021, before the property market chaos happened in September and the recent bank runs. So we can expect a major increase in the systemic risk since the research was published. Finally, they said that international investors should be concerned about the influence of smaller Chinese banks on financial stability and take their systemic and individual riskiness into account. Their increased exposure and connectedness may trigger a systemic event with wider repercussions, significantly larger than their individual size. And this research advocated for tighter regulation and supervision for smaller banks. Fortunately, the Chinese government has stepped up supervision of the small bank sector as they do fear the contagion effects and its implication for the whole financial system. Now, the root of China's banking crisis is the property market bubble that popped last year, but has been building up for the last 15 years. I explained it in depth in this video, so feel free to watch it if you want to learn more. This is Doverhill, and see you next time.